Good morning, everybody, and welcome to our webinar this month, our October webinar. Finally, we've got spring in Melbourne. It's nice 27 degrees, so I'm in very good spirits today. So we're looking at lessons learned from implementing IFRS 15. And as always, I have with me Kevin Frobers, who's based in our Sydney office. Hi, Kevin.
Hello, Aletta, and good morning, everybody.
Thanks. If we look at the outline of the session, it looks like a short outline, but it's actually quite packed. We look at what is next for our for-profit and not-for-profit clients. We do an overview of IFRS 15 just to set the scene, and then we look at lessons learned from implementing IFRS 15 over the last 12 to 18 months. And then we end up with, do you need assistance, where you can get free training materials, resources, but also if you need technical advice, who you should contact in our various offices in Australia. So that's the outline of the session. So what is next? I think a lot of our clients, our for-profit entities, have now finished the implementation of IFRS 9 and 15. Either for their 31 December 2018 financials or their 30 June 2019 financials, which is done or very close to being done. Therefore, for those for-profit clients, the next thing, the next big thing for 31 December 2019 or 30 June 2020 is the implementation of AASB 16 leases. After that, it looks like for 30 June 2021, we'll have to deal with the removal of the preparation of special purpose financial statements when you lodge your financial statements with ASIC or other regulators. So that's a longer term view. For our not-for-profit clients, for 31 December 2019, they will be for the first time implementing AASB 15 and AASB 1058. And also at the same time, they'll be implementing AASB 16. So they've got a triple whammy. Or if they've got a 30 June year end, they will implement these three new standards for 30 June 2020. So if we look at what is next, the common denominator between our for-profit and our not-for-profit entities is AASB 16. And over the last number of months, we've done a number of webinars for our not-for-profit clients, very specifically looking at AASB 15 and 1058 as well. So when we look at AASB 16 for both for-profit and not-for-profit clients, what we've seen to date is that if clients have up to about 10 leases, they usually try and do the transition adjustments, the ongoing management of their leases in Excel. If it gets to 10 or more, they start to say, can you help us? And they outsource the lease accounting to BDO. And usually if it's more than 200 leases, we start to look at BDO lead software as a service. However, underpinning all of this, we have sent out invitations and we invite you to attend our AASB 16 masterclasses, which will be running in November, December and February, and it will be running in Melbourne, Sydney and Perth. So if you are interested, please register for those. It's on our website, it's on LinkedIn, and it's also in our October accounting news. I've also put in a link here to the accounting news, which gives you an overview of what we'll be covering in these masterclasses. Very high level. We'll look at identifying leases, embedded leases in particular. We look at selecting the appropriate transitional method. We'll look at the ongoing assessments, reassessments, modifications, and we'll also do a comparison between IFRS and US GAAP, because a number of our clients have indicated that we've got an Australian subsidiary and they have to do IFRS 16 numbers for for ASIC, but they also have to do US GAAP numbers. So we'll end the day by touching on that as well. So in these masterclasses, we look at a comprehensive case study where very hands-on using Excel will show you how to do the accounting under AASB 16. So if you are up for the challenge to do lease accounting using Excel, we'll help you with that during the masterclasses. But if it's all too much, obviously speak to us about the outsourcing alternatives. I thought I'll just flag one of the main reasons we're doing the masterclasses is actually this diagram. And that is a lot of our clients are ready and have calculated the numbers in Excel to work out on date of initial application for most entities 1 July 2019. What would the journal entries be? What would the impact be on right of use asset lease liabilities, and what they expect the future depreciation interest expense will be? And to do that for all leases in Excel usually doable. However, what we're finding, and this is where a lot of clients, BDO clients and others are contacting us, they're saying, what do we do with changes to leases? So if there are remeasurements or reassessments of leases, which for some of the clients that we manage, it happens monthly, how do we do that? So it could be we change our view about exercising extension options or purchase options or termination options. Then you have to redo your calculations, reassess, but you have to use the new discount rate when you change your reassessment, and there will be an impact on your right of use asset lease liability, and all your amortization tables change. The second one is where there's a change in the estimate of the residual guarantee. Now, often we see that with clients who lease vehicles and there are balloon payments, but those balloon payments vary depending on the number of kilometers that you've traveled. And therefore, you might want to re-estimate that residual value. Now, in this instance, you use your original discount rate and you adjust your right of use asset lease liability. And then the last reassessment that we deal with regularly is CPI adjustments as well as market reviews. So as soon as there's a CPI adjustment and your cash payments are changing, then you have to change all future cash payments based on that latest CPI adjustment. Or if there's a market review, everything has to be updated. You use your original discount rate, you have to redo all the calcs, and there will be a journal entry to adjust your right of use asset lease liability at that stage. Actually, a more complex area is modifications of leases, and you'll see in today's webinar we'll also discuss modification of contracts when we recognize revenue. So modifications of revenue contracts and leases very complex. You could sometimes account for it as a separate lease, although it is in fact one legal agreement, and then sometimes it's not a separate lease, therefore you have to adjust the numbers you currently have. If there's a decrease in scope, I've put it in red, there can be a P&L impact because you are de-recognizing a right of use asset, de-recognizing a lease liability. Usually there's a loss to be recognized because your lease liability that you de-recognize would be bigger than the right of use asset that you de-recognize. Sorry, there will be a profit. And then also we've got some other lease modifications. And therefore, these other lease modifications, so it's not an increase in scope and the consideration is standalone price, or it's not a decrease in scope. All other lease modifications, again, you have to use a new discount rate. You can look at this diagram and you can see the ongoing month-to-month management of accounting for your lease portfolio, even if it's a small number of leases. Number one, are complex. And number two, it's quite a lot of work. So the master classes, we look at each and everything on this diagram. I just try to give you a bit of a flavor for it. We'll spend the master classes looking at each and every one and looking at examples. And then if it's all too much, and you would like to outsource it to us, please feel free to contact us. We can provide this outsourcing of or BDO lease management services to non-PI audit clients of BDO. So if you're an audit client of BDO and you're not a public interest entity, absolutely we can do this. We cannot provide this service to public interest audit clients or listed audit clients. And depending on your number of leases, etc., we can give you an annual fee. A little bit of the lease management services, and you'll see today if you've downloaded the slides from the webinar, I've also uploaded a process document for the outsourcing. So the steps exactly, how do we help you to get ready for 1 July 2019, and also the ongoing monthly process. How do we interact with you? And this is the IFRS team to make sure that your ongoing lease accounting is correct. And these are some of the deadlines. We also have BDO Lead, which is software as a service. If you want your own cloud deployment of BDO Lead. However, this cannot be provided to audit clients of BDO. Usually entities that have hundreds, thousands of leases go for this option, and we've got a number of them. But I also want to reiterate, we have a number of free resources helping you with AASB 16. So there are all these monthly webinars. There's a whole list of them over the last 3 years looking at AASB 16. On our accounting standards training page, you will see that there's online e-learning, interactive learning that you can do on AASB 16. We've got IFRS publications, so there's newsletter articles, and there's also IFRS in practice, a publication from International, more than 100 pages with worked examples. And we've got an IFRS 16 tab on our website with a lot of additional information about outsourcing BDO Lead. So there's a lot of free resources. However, if you've worked through that and you want some hand-holding, doing the calculations in Excel, please join us for our masterclasses over November, December, and February. Please register for those. And if you want to speak to us about outsourcing, please feel free to give us a call. Now, at this stage, I'm going to hand over to Kevin to do an overview of IFRS 15 and look at a few of the lessons learned, and I'll do the last few lessons learned, and we'll speak again at the end. So, Kevin, I hand it over to you.
Thank you, Aletta. And as I said, good morning, everybody. That was very useful, Aletta. I think one of the lessons learned, even before I get into it, is you've got to get this right. And one of the key messages you will see today in the IFRS 15 is, with 1 year of implementation behind us, that a lot of organizations didn't get it right. And I guess with IFRS 16, which is what Aletta's been talking about, is this is the last opportunity to get it right. So take the opportunity to invest in that process and don't leave it for the last minute, because I think you don't want to have prior period errors when you get a year down the line on the leasing standard. So with that, I'll get into the 15 standard. And I think I'll start this with a story. This webinar, the topic was probably created a year ago, and maybe Aletta and I didn't know what we were doing at the time in putting this particular topic in place, which was we knew it would be a year after IFRS 15 was implemented, and so it's essentially a bit of a retrospective on how did it go. But my little story is this. I have about 4 or 5 queries on my desk at the moment coming from a variety of companies who are re-looking at what they did with IFRS 15 a year ago, and they've got it wrong. And the reason they got it wrong was they didn't really get into the detail. Perhaps maybe they didn't take the time. I guess as a sector, maybe we didn't know everything about the standard, and some of the industry practices are starting to emerge. But that's probably my biggest lesson learned, is that you have to get into the detail with the standard. It's quite tricky, and one of the biggest things I think the industry or the sectors fought against was confirmation bias, where we just couldn't imagine an answer different to what we were doing. And as you'll see as we go through the examples today, you can very quickly get an answer that's different to what you've done in the past under IFRS 15. So let's go into the overview then, just to remind you about IFRS 15. It really is one of the big three standards. These are the international standards. Obviously, in the not-for-profit sector, there are AASB 1058 sort of drops off this underneath it for the revenue or the income side. But in the for-profit sector, I call it one of the big three. It's one of the revenue, leases, and financial instruments. And the key to all three standards, as a lesson learned, is that they're all contract-based. So, and you can see it in the revenue title, revenue from contracts with customers. AASB 9, the financial instruments, it's a contract-based standard. A financial instrument, by definition, is a contract that gives rise to a financial asset and a financial liability. And the leases standard is just like the others. It's a contract or an agreement between parties for the right to use an asset and so forth. And the reason why that's important is because you really need to get familiar with your contracts and the rights and obligations in the contracts to apply these standards. So that's the first thing you'll see. And a letter will get to modifications later on, I think, but you'll see there that it's all about a contract. So it's a modification of the contract that's important. So today we're looking at the revenue standard. So recognizing revenue to depict the transfer of promised goods, which arise from contracts with customers in an amount that reflects the consideration that the entity expects to be entitled. That's just the definition. Hopping forward, there's a 5-step model that goes with this, and I'll come back to the 5-step model a lot today. I think the biggest lesson learned from my side, and you'll see this in the case studies I've put together that I'll be dealing with, it's how these 5 steps actually link together. The first step is identify the contract, and that step's actually made up of at least 9 sub-steps, if you will, and those 9 sub-steps essentially work through what is in the contract. What are the rights and obligations that each party has? What does one party need to do? What does the other party need to pay? When do they need to pay it? All those things are really important in the first step. That sets you up for step 2, which is identify the separate performance obligations. What are the distinct goods or services that must be delivered or performed or transferred? Step 3 is determine the transaction price. And if I probably won't deal with it much today, but this is an estimation step. It's not what the invoice says or what the contract says. It's what the entity expects to be entitled to. So you can see that already on this one, you should be estimating transaction prices as opposed to waiting for the estimation or the change to happen. You should be doing that right up front. Step 4 is allocate the transaction price to the performance obligations in step 2. And then step 5 is recognize revenue when each performance obligation is satisfied. And then another lesson learned, which you'll see coming through in the case studies, is step 5 is all about the transfer of control. When does the service or the good or the control of the service or the good that you're delivering transfer to the other party? So that's just a reminder of the 5-step model. So I'm going to hop right into the lessons learned. So the way we structured this today is essentially Aletta and I are going to be giving you a number of case studies which represent, I guess, our unique lessons learned that we've seen. So I'm going to be looking at over time recognition. And I'm actually going to be using a construction example or real estate example. Now, there's 2 reasons for that. One is currently the BDO office in Sydney is sitting next to a construction site. And so it's possible while I'm doing this example, you may start to hear some banging and the banging and the drilling in the background unfortunately aren't influence when they're going to do that, but I've got construction on the mind, and so I decided to choose a real estate example. But please don't be put off by the fact that it's real estate or construction orientated. The lessons learned can be applied to any organization that is essentially trying to apply over time revenue recognition. And the second reason why I chose it is because the example that I'm going to use, or the case study I'm going to use, has actually made its way into BDO's IFRS in Practice publication. That's a free IFRS publication we have on our website, which means that you don't need to scribble down all the answers or all the concepts as I talk about it. You can actually go and find this example in that publication, and you'll be able to work through the concepts in there. So those are the 2 reasons why I chose it. Now, the overtime lessons learned here are threefold. One is you really do need to understand why you are using overtime in your revenue recognition. Far too often in the last year, we would have clients or organizations who would say that the reason that they're using overtime revenue recognition, but they weren't actually able to tell us why they were using that. So I'm actually going to point out how important that is. The second thing is linking your overtime recognition, which is in step 5, your overtime recognition, with the performance obligation in step 2. And that's the other lesson learned, is that the 5 steps actually do connect with each other. So step 5 is a consequence of step 4's 3, 2, and 1. So you really need to understand, for example, what the performance obligation is in step 2, because it drives the overtime recognition in step 5, which then, as the third lesson learned, is when to use input and output methods, which is then linking all the steps to the final recognition model. So I think the best way to get to do it is to actually then just cover some of these concepts. So here's the theory bit. There's 2 slides of theory. This is the first slide of theory, or technical theory. When do you use overtime revenue recognition? Now, this is essentially step 5, so I've jumped to step 5, but this is the organization must understand which of these 3 conditions it has met in order to justify the use of an overtime revenue recognition model. So let's work through them. The first one is a customer, this is number 1, the customer simultaneously receives and consumes the economic benefits provided by the vendor's performance. So as an organization, to use overtime recognition, the customer, whoever they were and whoever they've been identified as in step 1 in the contract, simultaneously receives and consumes the economic benefits. Now this one isn't much of a problem, or at least in my experience doesn't seem to be much of a problem. And the common example is a cleaning contract where the organization provides cleaning to a building or to a customer, maybe a shopping center is the customer. And as they provide the cleaning, so the customer benefits from it. They benefit from the cleaning that's happening, and they consume it at the same time. So that one isn't too much of a problem. I don't think it's been the problem child for a lot of goods and services. It's number 2 and 3 that prove problematic. So number 2 says that the vendor creates or enhances an asset controlled by the customer. Now, in construction and real estate type examples, which I'll be talking about later, there's a tendency to kind of jump to this one and say, oh, the reason why I'm using an overtime recognition is because I satisfy the second one. And the reason why I satisfy the second one is because I'm building a building and it's on somebody else's land, and therefore they must control it as I build it because it's on their land. Well, that's simplistic way of thinking about it, but as you'll see when we get into the examples, this is where the detail becomes really important, and this is where understanding the contract becomes really important, and understanding the rights and obligations become really important. It's also important to understand what the asset is, because you'll notice in step 2, satisfying a performance obligation over time, we don't talk about a good or a service being controlled by the customer. We talk about the asset. Now, I guess that implies a good, but it does require you to understand what the asset is that is being controlled by the customer, which then can link to the good or service that you're actually delivering in your model, to then understand what your revenue recognition is. And we'll actually spend some time on number 2, because it's the great difficult one that everybody seems to have real difficulties over. And then the third one is the vendor, being the entity performing the service, does not create an asset which the vendor has an alternative use for, and the vendor has an enforceable right to payment for performance completed to date. This is also a struggle one, because this one is very much bedded in legal principles and legal concepts. And in some cases, it's actually not enough just to understand the contract. You actually have to understand your legal rights to payment for performance completed to date. As a rule of thumb, and this is a general rule, so please just take it as that, a general rule, your right to payment for performance completed to date must include a profit margin. So it's not just enough for you to recover costs incurred to date for this one to apply. There really must be or generally there must be a profit margin on top of it. So essentially you need to be entitled to payment for work done to date plus margin. That's a general rule of thumb, and that's something you should really look to there. All right, so that's technical slide number 1. Let's look at technical slide number 2. Oh, actually, hang on. not going to do technical slide number 2. Jumping it, I actually asked the letter to swap these around. Technical slide number 2 will come at later, which is input and output. I'm going to get into the example. Sorry, one back a letter. A letter's driving here today. So the real estate interpretations, we're going to get into the case study, and I've actually put all the detail here. And the reason why I put all the detail on the screen is because I want you, as part of today, to recognize how important the detail actually is. And we're going to actually go through each line item. So bear with me as we work through each line item. This is the case study. And as I said before, this is in the IFRS in Practice 2019 Guide for Revenue Recognition, which is available on the video website under the IFRS Publications tab. So let's have a look. The customer, in this case, buys a residential unit from the entity. Entity obviously needs to recognize revenue. So at inception of the contract, the customer obtains a right to an undivided interest in the land and the unit being constructed on the land. So essentially we have a real estate or a residential unit property development happening here. The entity agrees to build and deliver the unit on the land in a given time, and the unit's being sold for a specified price in accordance with specified conditions. The entity cannot alter or replace the specified unit. So essentially you buy your unit and you get your unit. The entity retains the legal title to the unit until the customer pays in full after construction is complete. The customer pays a portion of the purchase price for the unit as it's been constructed and pays the remainder at the end. Now, up until now, you'll see this is generally how it works. You're buying off the plan as a customer. Construction is going to happen. You're going to get an undivided interest in the land. At the end, you got to pay, essentially settle at the end. So nothing that we don't recognize yet in property developments. Right, carrying on, the undivided interest in the land represents a notional fraction of the land on which the unit is constructed, and the customer can sell or pledge its right to the undivided interest in the land and part constructed unit during the period of construction, subject to the entity performing a credit risk analysis. Now, at that point, you'll start to recognize that the terms of the contract are really important. If you haven't yet figured it out, this represents essentially a summary of what's in the contract. These are the rights and the obligations of the parties. And each of these will become important as we go through it. So if you can really look at the lessons learned, the detail is really, really important. It's not as easy as we're building a unit, we're going to get paid at the end, therefore we have an overtime construction contract. That is the simplistic way of looking at it. The standard is quite explicit in its detail and the requirement for detail and understanding the contract. And I actually have a little rule of thumb. I call it the 3+30 rule. If a contract has more than 3 pages of definitions and more than 30 pages of detail of rights and obligations, it's going to be a complex contract. The definitions gives it away. More than 3 pages of definitions, it probably means that it's going to be a complex analysis. And you should probably use that rule of thumb. The longer the contract, the more complex the analysis for the revenue standard. It's actually just that simple. So moving along to the next one, the customer cannot change the structural design of the complex or the unit. And the customer and other customers who have agreed to buy real estate can together change the structural design, negotiate the change with the entity, and bear the related costs. It's an interesting one. Without breaching the contract, neither the entity and the customer can unilaterally cancel the contract. And finally, although the contract is irrevocable, the courts have accepted that requests to cancel contracts in particular circumstances, such as a deterioration in customer credit status, has been done in the past, and in that scenario, the contract has been cancelled, and generally speaking, there's a termination penalty that's been retained, being the original amount that's paid up front by the customer. All right, having waded through that, let's take a stand back and just remind ourselves on the next slide, and hopefully I got the slides right this time, of the 3 conditions that we have to look for overtime revenue recognition. So this is step 5. I have jumped to the step 5. Now, having jumped to step 5, I've assumed a couple of things. One is I've assumed who the customer is. In the previous example, it talks about the customer buying a residential unit. So in that scenario, the customer is the individual buyers. But you need to be very careful here. Sometimes the customer isn't the person buying the unit. Sometimes the customer is somebody else. And this happens a lot where, for example, you've got a development company who doesn't own the land, and they've signed a contract with the landowner to develop the property. And in that scenario, they might also have the obligation to sell the units in, let's say, a marketing arrangement. The question is, who's the customer? The customer is the party that you enter into your contracts with on an ordinary basis to earn your revenue. So a development company who's signing arrangements with landowners to develop a piece of land and then sell and market those units to end customers, the end customer may not be the customer for the development company. So the first thing here is, before you even get to overtime revenue recognition, which is the lesson learned today, is to first of all understand who the customer is and who the contract is. But in this case, we've assumed that the customer is the residential unit buyers, the end customers. The second thing is then, what is the performance obligation? And in this scenario, we've assumed it's building the units. But that's not always the case. Depending on who the customer is will also drive what your performance obligation is. And I have seen a contract actually in the last week where the developer signs an agreement with the landowner to develop the land, finance the land, sell the units in a marketing activity, and they just end up as the project manager, because they also have to find a construction company below that to actually carry out the work. So the very important question is, don't just jump to, in this question, that you are the developer and therefore you're building a unit. The question is, who's your customer? Step one. And the second thing is, what's the performance obligation? What have you promised to do? But in this case, step two clearly was the construction of the units for the end customers who are buying each unit. With that in mind, let's have a look at the three items of overtime recognition. I think we can all see straight off the bat that number one doesn't apply. The customer, being the residential unit owners, don't consume the benefits provided by the construction performance. So one doesn't apply, and that's not the purpose of today's session. But I'll have a look at number two. The vendor creates and enhances an asset controlled by the customer. So the first question is, what's the asset? Now, the IFRS Interpretation Committee actually looked at this one, and this example is straight from an interpretive decision made at the international level back in March 2018, which is why it's also in our IFRS in practice document. And the reason that they actually looked at this one is they got a number of queries that particular month. So March 2018 was a big month for the IFRS Interpretations Committee, especially when it came to real estate. There were at least two agenda items finalized that month which dealt with real estate and the new IFRS 15. But in that particular interpretation committee, they actually make the point that you must identify the asset first. So let's talk about that asset. What is the asset in this example? The asset in this example is not the control over the right to obtain the real estate in the future. It's control over the asset that's being created. So it's actually the unit itself. So going back to our example, we actually had things like the ability to resell or pledge a right in the undivided interest in the land of a part constructed unit. In that scenario, the ability to resell or pledge the right in the land or the undivided land isn't the asset in question here, because the customer has bought an asset. The asset has been the constructed unit, and that is the asset that they have to have control over for this number two to apply. So running through the fact pattern, and we don't need to bring the fact pattern up, but I'll run through the points that the IFRS Interpretation Committee looked at. They said, well, first of all, the customer doesn't control the underlying asset during the construction period. The customer can resell the right to the interest in the land, but not the unit itself. And the other thing they actually pointed to is the ability of the customer to change the structural design of the actual unit. They can't do anything without other customers, but since the other customers aren't party to this contract, the individual can't change the structural design and therefore doesn't control anything during the construction period, meaning two cannot be met as an overtime contract. And it's at this point that a lot of entities sit back and say, really? But a lot of organizations in the constructors in the construction industry will have already been accounting for these, let's say, as essentially goods being sold at the end of construction. But a lot of organizations who aren't familiar with the construction industry find that a complete surprise, because construction traditionally was always an over time recognition for revenue. And that's not the case here, because essentially we are selling units which we control, and we pass them along to the customer at the end of construction. Number 3 can't apply because we only get paid at the end, essentially, other than the deposit. The rest of the payment happens at the end. So the vendor actually does not have any enforceable right to payment for performance completed to date at any point during the construction, which means in this scenario, overtime recognition cannot be applied. But that could be very different if the contract terms change. And that's really the lesson on this one. If we move to the next slide, we'll go back to my lessons learned. And the next slide will actually say things like the detail is important. You need to understand why the overtime recognition is appropriate. And more importantly, you've got to really get stuck into the detail of your contract. What are the rights and obligations, and link those to the actual performance obligation and the asset being constructed. So that's a lesson learned, is really need to get into this. The other thing that's important is that different contracts have different outcomes. So unless the contracts are standardized, you could have different accounting answers from one contract to the next. All right, now I'll get to the input and output method, which is the technical slide 2. And sorry, Aletta, for moving that around before. So here's my technical slide 2, the input versus output methods. A lot of organizations will look at this and say, and I'm using the real estate example again, when we have an overtime contract, how do we measure progress towards satisfying that? So assume we have an overtime contract in our real estate example. Using an output method or an input method to measure progress towards that obligation is quite important. Now, the output method here is things like quantity survey appraisals, milestone reached, units produced versus units delivered, essentially output of the product being delivered. And the input method is obviously resources in, such as costs, labor hours, and so forth. Nothing really new. This used to be like this under the old construction contract standard, but it essentially applies to any good or service that is transferred on an overtime basis. You need to apply an input or an output method. Now, the lesson that I learned from this year is that this is not a choice. You must use the most appropriate of these methods to recognize revenue that faithfully depicts the progress towards delivering the performance obligation. So a number of organizations I've come across, they tend to want to go to whichever one is the easiest. And often that's the input method, costs incurred. So costs out of a total of budgeted costs must be a percentage of completion type method, and therefore they want to use that one. But that doesn't necessarily mean it's the right one to use. And I'll show you why a lot of organizations try to use the input method. I've actually put 2 examples on the slides, and we'll look at the first one. This is just a calculation of the output method using let's say quantity surveyors to work out, for example, what my profit would be along the way. And remembering, with an output method, there would be no link, or there would be no link to, let's say, the costs incurred. So the expenses or costs that are being expensed won't necessarily be reflective of the proportion of revenue earned. And then you start to get things like what we call lumpy profits. So the output method is not favored by a lot of organizations because the gross margin goes all over the place. The expenses aren't a representation of performance to date. And this is why a number of organizations who are using overtime revenue recognition want to use an input method, because they don't want the lumpy profit. They don't want the gross margin in one year to be 33% negative and the next year to be 50% positive. So they tend to want to use an input method. Well, first of all, the question is, should you be using overtime? Because you need to satisfy one of the 3 conditions. And if you are in overtime recognition, maybe the output method is right, because it's not about matching in the P&L anymore. It's actually about matching in the balance sheet, or I like to think it's about matching in the balance sheet. But certainly matching revenue and expenses in profit and loss is not the objective of the standard. Recognizing revenue that faithfully depicts the transfer of the performance completed to date, that's the objective of the standard. And perhaps the output method is the most appropriate method to faithfully depict that. Using an input method example, this is the one everybody wants to go to, because you can see a nice little constant gross margin at the bottom, 20%, 20%, 20% for each year. Now, perhaps the input method is appropriate on an overtime contract, but it doesn't necessarily mean it is the one that faithfully depicts progress towards. And one of the tricks with the input method is which costs are those that faithfully depict the performance to date. We're having this with a number of engineering companies at the moment, and especially any type of service where there's mobilization and setup cost at the beginning. And it doesn't have to be only construction. We're talking some financial services, debt management agreements. They're all the sorts of agreements where there's a setup component at the beginning before the service actually gets delivered. Those costs aren't the costs that are actually included in measuring progress towards completion. There may be expenses that relate to the actual project themselves, so costs to fulfill the project, but they don't necessarily get included in the calculation of progress towards. Because if you've spent $100,000 worth of costs on $1 million contract and none of those costs are related to actually delivering the service, they're all internal setup costs, then you haven't actually delivered any other service, so you can't have revenue. So when you use the input method, yes, you might get a nice smooth gross profit, and it might be the appropriate method to use, but then it becomes important to make sure you include the correct costs that actually are representative of the service delivered to date. And so those are the two lessons under the input and the output method that I just wanted to bring to your attention. Finally, then, just to remind you that the use of the input and output method when you have overtime recognition is not a choice. You must use the method that recognizes revenue that faithfully depicts your performance to date, and not default to the one that gives you the smooth profit or the matching in the P&L, because that's not the objective of the revenue standard. Those are my lessons learned in a nutshell. I think I've given Aletta more than a few minutes to get into her case study, so I'll hand back to her so she can look at contract modifications.
Thank you very much, Kevin. I think what is really interesting, and maybe the reason we started with AASB 16, is we have found that many entities left the assessment and diving into the detail a bit too late. And therefore there was quite a bit of a rush and a flurry of activity towards the end, especially when lawyers had to get involved to look at enforceability and terms and conditions of contracts. And we know with leases, we're talking big numbers in general. If you've got long-term leases or multiple leases, we're talking big numbers, and therefore an advanced warning to your board and audit and risk committee around what the potential impact is always works really well. So we thought lesson learned would be, let's look at the new standard a bit earlier. Kevin, thank you very much for sharing those lessons with us. I have picked 4 lessons. I've picked contract enforceability, which links very nicely to what Kevin talked about. I then also picked contract modifications. And as I said earlier, we also have issues around modifications of lease agreements. I've also picked principal versus agent because a number of our clients had some difficulty and had to reassess whether in particular transactions they are actually the principal or the agent. And then the last one is around licensing, or one could say software in general. On whether it's a software development service we're providing, or is it licensing of previously prepared or developed software, and also what are the complications there. So those are the 4 key ones that I thought I'll have a look at. The first one around contract enforceability. Now, under IFRS 15, it specifically says in step 1 that a contract does not exist if each party to the contract has the unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party or parties. And I thought when I read that, there's a lot of information in there. I think if we unpack it a little bit, first of all, why is it important to say that a contract does not exist? What are the implications? What are the so what? Remember, if we don't have a contract under 15, we can never recognize revenue. So we can only contemplate and move to step 2 and possibly to step 3, 4, 5 if we at least have a contract in step 1. So it's important to assess whether we've got a contract or not. And therefore, here where it specifically says you do not have a contract in the following instances, there are two key things that's maybe not clearly articulated, as you know, I think in pictures. I thought the first thing is we have to make sure we've got a wholly underperformed contract. And if we have, we then have to look at, do we or do both parties have a unilateral enforceable right to terminate without compensating another party? If we've got both of those hurdles, we don't have a contract. So if we unpack them a little bit and we would look at when do we have a wholly unperformed contract? Two things. The entity has not yet transferred any promised goods or services to the customer, so we haven't given them anything, and the entity has not received or is not entitled to receive any consideration in exchange for promised goods or services. It's wholly unperformed. Both parties have done nothing to date, number one. And then the second thing, to make sure we don't have a contract or that will kick us out of step 1, is whether both parties have this unilateral enforceable right to terminate without compensating the other party. So really we're talking about contract enforceability, and we are linking it to the legal enforceability rights. I think although IFRS 15 contains guidance on when a contract exists, and we've got a number of hurdles to jump, we've often received questions on how to assess whether we have a contract for accounting purposes, and if we have a contract for accounting purposes, what is the term of that contract? And it's very similar questions to what we see in AASB 16. So I've included 4 examples to illustrate this a bit more, and they each build on each other until we get to example D, which is the most complex. Now, the first example says, what if an entity enters into a service contract with a customer under which the entity continues to provide services until the contract is terminated? However, each party can terminate the contract without compensating the other party for the termination. So there's no termination penalty. So we have this unilateral right to terminate without paying a penalty. So in this instance, we'll say the duration of this contract does not extend beyond the services that's already been provided. Because if we look at it, we enter into a service contract, it's basically a month-by-month service contract. And therefore we're saying, the term is only the services that's been provided, that is the term. Once you've provided the services, you're entitled to payment for those services. If people terminate, they don't have to pay you anything. They can terminate at the end of the month and off you go. So that's the first one. Example B says an entity enters into a contract with a customer to supply services for 2 years. Each party can terminate the contract at any time after 15 months from the start of the contract without compensating the other party for termination. Now, in this instance, we're going to say, all right, for the first 15 months, we locked in. We cannot walk away without compensating the other party. So the duration of this contract is at least 15 months. After that, we will revert back for the next 9 months. We'll revert back to example A, and it will be a month-to-month situation. If we go to example C, it says an entity enters into a contract with a customer to provide services for 2 years. Either party can terminate the contract by compensating the other party. Therefore, in this situation, we've got a contractual period of 2 years. And the reason for that, if we go back to the previous one, although we could have a wholly unperformed arrangement, we do not have a unilateral enforceable right to terminate without paying a penalty. Therefore, yes, a contract exists, and a contract exists for the whole 2 years. Now, to take it a little bit next level, in example D, an entity enters into a contract to provide services for 24 months. Now, either party can terminate the contract by compensating the other party. The entity has a past practice of allowing customers to terminate the contract at the end of 12 months without enforcing collection of that termination penalty. So the question is, does that mean in this situation we have a contract for only 12 months? Because based on past experience, for the next 12 months, really they can terminate without needing to pay us or without getting this termination penalty. That's the question. So the question is whether the contractual period is 24 months or 12 months, and it depends on whether the past practice is considered by law. And I want you to circle the by law, and that could be different in different jurisdictions, where the past practice is considered by law to restrict the party's enforceable rights and obligations. So this now becomes a legal question. And therefore, the term or the existence of the contract and the term of the contract is a legal question. So if we go to a court of law, would the court say this is a 24-month contract, or would they say it's a 12-month contract? Because, listen, in the past, you've allowed people to walk away without paying a termination penalty. So the entity's past practice by allowing customers to terminate the contract at the end of the 12th month without enforcing collection of that termination penalty affects the contract term only if the practice changes the parties' legally enforceable rights and obligations. If past practice doesn't change it, then the contract term is still 24 months. Now, you can see here that these days accountants and lawyers have to be very good friends. And Kevin would agree with me that more and more, Kevin, we are speaking to lawyers, and we ask lawyers to give us opinions about legal aspects of contracts which will influence our IFRS 15 answers. And I think that is one of the big lessons learned for me personally on when would we look at the legal, or when would we need legal views, and when would we go with the accounting substance over form. Now, personally, I've been educated this way, and I've always personally favored substance over form, firmly believe in substance over form. But as Kevin said right at the start, very heavily, these new standards are looking at contracts. And although in many cases we still look at substance over form, the standards are tricky because in the weirdest places it requires you to look at legal form, it requires you to look at law and legal interpretation. And I think that can trip you up very easily if you're not aware of that. So although I personally believe in substance over form, this standard and all three of these standards have introduced the notion quite often that we have to look at legal positions. The other thing I wanted to say here, because we're working with a lot of clients now getting ready for AASB 16, is what we've discussed here around contracts and contract enforceability and contract terms are quite different for AASB 16, whether we have a lease agreement, whether it's enforceable, what the lease term is. And paragraph B34 of AASB 16, creates a bit of havoc. And one of the things when we discussed it in BDO globally that I've commented and a lot of people have commented on is there's this contradiction, actually a big contradiction, between AASB 15 and AASB 16 around contract term. So that's something to look out for. So the next one that I thought I'll touch on is contract modifications. Now, contract modifications, I think initially when we've implemented IFRS 15, we focused on, do we have a contract? Do we have to combine contracts? What are the 5 steps? However, now that you've already implemented 15 and you've assessed all the contracts that existed on the date of initial application, contract modifications become very important, because a contract modification is a change in the scope, so you can do more or less, and or the price of a contract, very important, that is approved by the parties to the contract. So we need that contractual approval in order to consider contract modifications. So this sometimes in practice, and I know in Kevin's construction world, it could be a change order, it could be a variation, it could be an amendment. Important, it has to be approved. So if we look at IFRS 15, adjustments are only made for a contract modification when either new enforceable rights and obligations are created or existing ones are changed. So if initially we said we had a contract and these were the enforceable rights and obligations, we'll only consider the IFRS 15 implications if there are new ones, if there are changes to the original ones, and that's why we need it approved and we need it properly documented. Now there's 2 big things here. Sometimes a contract modification is treated as a completely separate contract. And that is the easiest way to deal with a contract modification, because your original contract just continues the way you always planned for it to be accounted for. And the new contract or the contract modification is treated for accounting purposes as a separate contract, and you look at it on its own, which is simple. However, you would only treat it as a separate contract if the scope of the contract changes due to additional goods or services that are the distinct that's been added to the contract, and the price that you pay for those goods and services are fair market price. Interesting again, accounting for this contract as a separate contract under AASB 15 and the rules on when you account for it separate is very similar, however, in this instance on what we do with a modification of a lease agreement. If there's an increase in a lease, or increase in the scope of a lease, and also if you are paying fair market value for that increased scope, you'll treat that amendment to your lease as a separate lease, and that's the easiest way. So at least here we have consistency between AASB 15 and AASB 16. On this slide, however, we're looking at a situation where we did not meet the criteria to account for this contract modification separately. And now we know, oh dear, this contract modification is now interplaying with my original contract, and most often this would be the case. And what do we do with it now? And there's 2 distinct potential answers, and there's also a potential mixed approach, because you could have a bit of both. Your first question is, are the remaining goods and services to be transferred under the original contract distinct? And if you say, so it's the remaining goods and services under the original contract distinct. If you say yes, what you will do is you replace the original contract with this new contract. So there's no adjustment to revenue that you've recognized to date, and you consider the treatment of the remaining performance obligations as well as your new performance obligations together. So you terminate the old one, and whatever's left of the old one, whatever you've added under the modification, you start all over. If the remaining goods or services from that original contract is not distinct, question is there only a single performance obligation? If it's a single performance obligation, so whatever's left plus what you've modified and added, if it's a single performance obligation, you will just continue with what you've done in the past. And this is the hardest one because you now have to treat this modification as part of the original contract. And you now have to re-estimate how much revenue you should have recognized to date. So whatever you've booked in the past, now that you've added scope, etc., your percentage of completion will now be less. But there will be a higher transaction price. So, sometimes it leads to more or less revenue recognized to date. And sometimes there is a mixed approach. So with contract modifications, I think the issue here is, first of all, should it be treated completely separate? And if not, how do we account for it in combination with our existing contract? Principal versus agent. Again, a number of clients had to consider this very carefully and actually had to reconsider their previous assessment, whether they're a principal or an agent, under the previous AASB 118, because AASB 118 had very limited guidance on whether you're a principal or an agent. So here, when a third party is involved in providing goods or services to a customer, the vendor is required to determine whether the nature of its promise is a performance obligation to provide the goods or services itself. So you're the principal, you have the obligation to provide the goods or services, or your obligation is to arrange for a third party to provide those goods or services. Now, the interesting thing here is often when I'm the principal and I have to provide the goods or services, I still have the ability to use subcontractors to help me to provide goods or services. So really, in practice, are those subcontractors for you, the principal, or are those subcontractors agents? And therefore, the accounting would be very different. So that's where I've seen it quite often, where we've got subcontractors involved, and exactly whether those subcontractors are the principal or the agent, and how does it influence you. So the indicators that you are acting as a principal is you have the primary responsibility to provide the goods or services to the customer. You assuming inventory risk before the goods or services has been transferred to the customer, or even after you've transferred the goods to the customer, if they have a right to return, they would return it to you, then you the principal. And also you've got discretion in establishing the price of the goods or services. Now, again, a lot of judgment required. These criteria are things to consider, but it's not an exhaustive list, and in certain situations, certain ones are more important than others. The one that we've seen a lot of issues in is where we've got drop shipment arrangements, which is actually very common these days. I've got 3 daughters, and the number of drop shipments arriving in my house on a daily basis is actually very scary. These kids order skirts and dresses and whatever. My son is actually quite embarrassed because when Australia Post arrived, they've already put his name in to sign for it, because they're all at school and he's at uni, and he often has to accept delivery for these things. Very embarrassing for a 21-year-old. So drop shipping is a supply chain management in which an entity does not keep physical stock of the goods it sells. It simply arranges for the sale between a customer and its supplier, and the supplier ships directly to the customer. Now, this is becoming more common in online retail environment. Tell me about it. Where online retailers are keeping less physical inventory on hand, as customers do not ever need to interact with the inventory held by the retailer. So you go online, you order the goods, the entity will just say, could you please ship this to that address and have it delivered? So in this situation, a physical possession and legal title are less likely to be relevant to determine whether the retailer who facilitates the shipment between the supplier and the end customer is a principal or an agent. So in this instance, you would look at different things. You would consider, does the retailer have the latitude to establish the price? Does the entity only receive, so this would be, remember, we're either looking at the retailer, the retailer who's organizing this. Does the retailer have the latitude in establishing a price, or does their supplier give them very strict pricing policies? Does the entity only receive a fixed fee for establishing the relationship between the supplier and the customer? Who does the customer deal with in the case of a product quality issue or returns? Do they return it to the supplier directly and liaise with the supplier to have it repaired, returned, or do they deal with the retailer? Are the goods customized or interchangeable for other goods? And which entity has the primary or the greater responsibility towards the customer that receives the goods? So I think this is a very common scenario to determine whether the retailer or actually the supplier to the retailer is the principal. The last one I would like to look at is licensing. Now I have a number of clients who do software development and or license software to their clients. So it could be, and it's so interesting that for a number of these clients, I looked at up to 10 different agreements with different customers, and the answers were very different. The analysis were very different because, as Kevin said earlier, you have to understand what is the good or the service that we are providing to this customer. Is it ultimately that we are developing bespoke software for them and implementing bespoke software? Or, and then you look at the normal criteria. Is it a service? Is it controlled by the customer? Is it specialized, to determine in step 5 whether we recognize revenue over time or not? Or is it licensing? So you've previously developed, in our example, Kevin, we've developed, or BDO Germany has developed BDO Lead, and now we license that to customers. So it's not bespoke for individual customers. It's been developed over the last 5-6 years. Now we license it. How do we recognize that licensing fee? Is it upfront or is it over time, over the period of the license agreement? So if you license it for 5 years, do we recognize the licensing fee on day 1, or do we recognize it over 5 years? So there's so many different areas here. Step 2 in particular, to identify the separate performance obligations, is very problematic for licensing, because there could be upgrades, updates, support, help desk, training. Is that all linked to the licensing agreement one performance obligation, or are those distinct separate performance obligations? And I have to tell you, I've seen them all, and it's really heavily dependent on the terms of the contract. If we just look at licensing in particular in step 5, so this is not software development, this is just licensing. In this scenario, there's a decision tree that we've put together based on additional guidance that was issued by the International Accounting Standards Board after the original issue of IFRS 15. And here it's all about, do the license give the customer the right to use the entity's intellectual property as it exists at the point in time at which the license is granted? If that is the case, you would recognize revenue at a point in time. So that would be, you get the license, you get the software, you download it, and you can use it for as long as you want. You've got the right to use it, and nothing else has to happen to keep it going. It's on your server, completely in your control. It's actually very similar to buying software at JB Hi-Fi. So the entity can recognize the revenue at a point in time. That is opposed to where a customer has a right to access the intellectual property as it exists throughout the license period. If that is the case, it means, and this is what we do with BDO Lead, BDO Lead is hosted in the cloud. So BDO is providing hosting services in the cloud for the software, your data in the software, and therefore you cannot use BDO Lead without us hosting it in the cloud. Therefore, you get a right to access BDO Lead. We're hosting it, we're maintaining it, we're updating it, we're upgrading it, and therefore we would recognize the revenue over time. In order to help you with the two extremes, in the standard, they put in some questions. Are the entity's activities expected to significantly change the form or the functionality of the intellectual property? If you say no, let's think about another thing. Is the ability of the customer to obtain benefit from the intellectual property substantially derived from or dependent upon the entity's activities? If you're not depending on us and us hosting it, it's on your server, you can use it, we don't have to update it, etc. Then you've got the right to use it on day one, and we can recognize revenue on day one. However, if we host it, then does the activities result in the transfer of a good or a service to the customers as those activities occur? Most usually we would say yes, and therefore we have the right to access it over time. I should say what I've seen in practice when I started looking at licensing under IFRS 15, 18 months to 2 years ago, a lot of entities previously recognized a revenue at a point in time at the start under the old AASB 118 because the guidance was very vague. And it was a big shock that quite often now they had to recognize it over time. However, in the last 18 months, a lot of software entities are actually licensing software as a service. They host it, and therefore, and they, charge you monthly payments for that. So most of them, I think, have changed their business model. I think it was not related to the change in IFRS 15, but the technology space have changed to hosting services, which makes this assessment very clearly that it's recognizing revenue over time. So it's funny that the technology changes and IFRS 15 did end up meeting each other. Kevin, is there anything else that you wanted to add before we wrap up the webinar?
No, I think we've comprehensively covered it, Aletta.
Thank you very much, Kevin. Thank you for your time again today. So if you need assistance, we do a lot of different things in IFRS Advisory. We have our monthly webinars, and we've given you a little bit of a summary of all the webinars just in the current year that we've done on IFRS 15. Which is a long list. We've also done a number of webinars on IFRS 15 in 2017 and 2018, and we'll continue so in 2020. We also do newsletters. I know in this month's October newsletter, there is a particular article on IFRS 15, step 5. We also have our e-module training courses. I've given you a copy from our website on where to find it. And then obviously you can contact any of our IFRS Advisory partners to assist you. Wayne and Susan in Perth, Kevin in Sydney, Clark in Brisbane, and I'm national. And then finally, you'll see here that there's been a change. Right at the bottom, Christine Webb, Senior Manager, joined Kevin in Sydney at the start of this month. Kevin is very excited to have another very experienced person with him in Sydney. Christine and Kevin have worked together before, so we're bringing them back together. So I thought I'll just flag that as well. Any questions, please feel free to contact Kevin or I. Otherwise, thank you very much for joining us today.